What happens if you haven't filed taxes in 20 years and suddenly find yourself holding $1 million in crypto plus a hefty retirement account right as you're about to lose your job? Today, we're unpacking this high-stakes scenario, and by the end, you'll know the risks, the options, and what everyday investors can learn from this tangled situation. Let's jump into it because this is the kind of financial crossroads that can happen more often than you might think. Here's the setup. A 55-year-old is about to be laid off. They haven't filed taxes since the early 2000s. Right now, they have $800,000 split between two 401k plans, a $69,000 pension lump sum, and, here's the kicker, $1 million in cryptocurrency. First off, if you're in this boat or anything close, your heart might be racing. So let's break down what's really at stake. Not filing taxes for 20 years is a big deal. The IRS doesn't just forget about old tax returns. In fact, there's no statute of limitations on unfiled returns. They can go back as far as they want if you never filed. But, and this is important, the IRS is usually more interested in getting people back into the system than punishing them. Still, penalties and interest can add up, and if there's any suspicion of fraud, things can turn criminal. Now, let's talk about the assets. The 401ks and the pension are traditional retirement accounts. They're tax deferred, meaning you generally don't pay tax until you take money out. But that million in crypto, that's a whole different animal. The IRS treats crypto as property, not currency. That means every time you sell, trade, or even use crypto to buy something, it's a taxable event. If you've been buying, selling, or trading crypto over the years and not reporting it, there could be significant capital gains taxes owed. And yes, the government is getting a lot better at tracking crypto wallets and transactions. The days of flying under the radar are fading fast. Let's add some numbers to this. If you bought Bitcoin in 2014 when it was under $1,000 and now it's worth $60,000, the IRS wants to know about that profit. If you sell, you could face long-term capital gains taxes, which for most people range from 15% to 20%. On $1 million gain, that's potentially $150,000 to $200,000 owed before considering penalties for not filing. But what if you haven't touched your crypto? Just holding it isn't a taxable event. The problems start when you sell, even if you're just converting crypto to cash to pay bills after getting laid off. And with the job loss, you might need that cash soon. Now back to the missing tax filings. If you haven't filed, the IRS can file what's called a substitute return for you. Spoiler, it won't include any deductions or credits you might be eligible for, so your tax bill could be much higher, and they can garnish wages, seize assets, or put liens on property to collect. On the bright side, the IRS also offers ways for people to catch up. There's something called the Voluntary Disclosure Program, where you come forward before they catch you, file your back returns, and often avoid criminal prosecution. You'll still owe taxes and penalties, but it's usually a lot less frightening than waiting for that knock on the door. Let's look at the retirement accounts for a second. If you're 55, you can start taking distributions from a 401k, but you'll usually pay income tax and possibly a 10% early withdrawal penalty if you're under 5912, unless you qualify for an exception. The pension lump sum is similar, taxable when you take it. If you have $800,000 in retirement savings and $69,000 in a pension, that's a strong position for most people. But those funds are harder to get at quickly, and drawing on them could push you into a higher tax bracket, especially if you're also realizing big crypto gains in the same year. So what should someone in this situation do? First, don't panic, but act quickly. Get a qualified tax professional right away, preferably someone with experience in cryptocurrency and back taxes. Don't try to hide or ignore the problem. The IRS is much more forgiving when you approach them first. Second, try to gather as much documentation as possible. Crypto transactions, retirement account statements, old W-2s, or 1099s if you have them. The more detail, the better. And third, consider the timing. If you're about to be laid off, your income will likely drop, which could actually help with your overall tax rate when you finally do file. But don't use that as an excuse to delay. It's all about controlling the narrative, not running from it. Here's an interesting angle. You're not alone if you've fallen behind on taxes. The IRS estimates millions of Americans don't file every year for all sorts of reasons. But with the rise of digital assets like crypto and new laws requiring exchanges to report transactions, it's getting harder to stay hidden. Looking ahead, this case is a wake-up call for anyone dabbling in crypto or skipping tax filings. The rules are tightening and the stakes are high, but with proactive steps, most people can get back on track, often without catastrophic outcomes. If you made it this far, I hope you learned something new and maybe even feel a little more empowered about facing tough financial situations. If you found this useful, hit like, drop your questions or stories in the comments, and subscribe for more smart, practical finance insights. And here's something to think about. As the financial world gets more digital, the line between off the radar and in the crosshairs is getting thinner every day. How prepared are you for the next big shift? See you in the next video.